Hey, so there's lots of talks around about when the real estate market and the stock market is going to crash. And in this video, I'm going to do my best to simplify for you why the markets haven't crashed despite the US economy being in a recession. And to do so, I'm going to use an analogy of the average American who makes $50,000 a year, yet they spend $70,000 a year. So to the outside, this person looks like they're doing pretty well. They've got the new car, they've got the new TV, they've got the new iPhone, but they're not looking at the balance sheets and they're not looking at their actual finances. So they don't really know how well they're doing, and that's sort of how the US economy looks right now. Real estate prices are up, the stock market is up, things look pretty good, yet we know that economically we're hurting. GDP is down, inflation is down. Now, how is this person who makes $50,000 a year able to spend $70,000 a year? How is that even possible? Well, simple. You just use a credit card. So what this person is doing here is they're seeing that new TV that's $1,000 and they're saying, I don't have $1,000 in my bank account right now. I can't afford that TV. But I do have $20 in my bank account, and guess what? If I put this on the credit card and just make a minimum payment every single month, it's just an extra $20. I can do that. So yeah, let's go ahead and get the new TV. And they're doing that for, all of their purchases, whether it be a new TV, a new iPad, a new laptop. You get the point. They're able to afford it when they say, I can't afford it now, but I'll pay for it tomorrow in the future, even if I have to pay more. And that's what the government is sort of doing in a way, right? By printing more money, they're borrowing, they're putting it on a credit card in order to buy things that they can't afford right now. Mortgage-backed securities, bonds, and these are things that are pushing the prices up of real estate. They're putting interest rates essentially right on that credit card by keeping them low, again, pushing up real estate. So now the question is, how long can this person keep this lifestyle up for? And some of you may know people like this, and the answer is quite a while, right? It's not like 1 year, 12 months, and this person's going bankrupt. But eventually, over time, even that minimum payment, if they keep this lifestyle up, will become too much and will continue to grow to the point where this person making $50K a year is struggling just to even make that minimum payment. And now at this point, they're facing delinquencies, they're missed payments, and they might even have to declare bankruptcy. And that is a possibility of what can happen to the government. Now, the thing that I think people are underestimating here is they're saying the market's gonna crash in 6 months, it's game over. Well guys, if the average American can push this lifestyle on for quite a while, don't you think the government can do so as well? I mean, I think we need to give the government a little bit more credit. So, let's take a look at a scenario of how you would get out of this, right? Let's look at first this person here is making $50,000 a year. They're spending a lot, they're getting that credit card racked up. Can the government get out of this situation? Can this person get out of this situation? Yes, it's possible. And I'll leave it up for you to decide how likely you think this will happen. But let's look at how they would get out of this. If they wait to the point where they're racked up in debt and they can't even afford to make the minimum payment, it's too late. But if before they get to that point, let's say they weren't out there buying stupid things, and that when they racked up all this debt on their credit card, it was because, say, they lost their job for 6 months and they had to put their rent and utilities and food on the credit card for those 6 months, and they were hoping and believing that they would get a job after that and then be able to pay this debt off. So then let's say after those 6 months of being unemployed, then they get a job back, and maybe they're making the same amount, or maybe they're even making more. Maybe they're making $80,000 now, right? They've got a better job. So now they're able to pay some of that debt off. But in order to do so, they're going to have to decrease their lifestyle. You can't keep spending that $70,000 and only be making $80,000 and expect to pay that off in a reasonable amount of time. This is going to have to go down. They're going to have to start spending $50,000 while making $80,000 in order to actually pay that debt down. And the thing is, though, to do this in a non-painful way, the more that they make, the less painful that it will be. So let's say that this person came back and only made $50K. They got their same job back. still at 50K. Well, they're going to have to decrease their lifestyle even further. Maybe they're going to have to live like they're only making $30,000. And so that's going to be pretty painful for most people to go from a $70,000 lifestyle down to a $50,000 or $30,000 lifestyle. But that's what's going to be needed in order to pay this off. Now, let's take a look at an easier scenario, right? Where you wouldn't really feel the pain. Let's say this person, maybe their business takes off, or maybe they get a job in computer tech. I don't know. Imagine they get a really high paying job where they're making $250,000 a year. Well, now they can probably keep their lifestyle of $70,000. They might even be able to increase it a little bit, and they can still pay off all their credit card debt that they racked up. No problem. So they're gonna really feel no pain here. They're able to keep their lifestyle, maybe even increase it, and they're able to pay off their debt. Now let's look at how this translates over to the government. So the government right now is laid off. So they're trying to make their mortgage payments, their rent payments, and pay their food bill. And so they're buying bonds, they're buying mortgage-backed securities, they're keeping interest rates low, and they're essentially putting that on the credit card. And what they're hoping is that the economy will recover and GDP will come back and that they can pay this off. Now, it will probably be painful if GDP and the economy doesn't come back very strongly, because then the only way to really pay this off, right, if it doesn't come back strongly and more than what GDP was before, well then what is the government going to have to do? They're going to have to create more revenue, right? Their income's going to have to go up in order to pay this debt off. So that means they're going to have to increase taxes, which is going to hurt the average person. That means less money in your pocket, in your paycheck for you. And they're probably going to have to decrease government spending as well. And they can't just pick one area. If they're really going to want to have to cut back at this debt, they're going to have to cut back in almost all programs. Military, Medicare, Medicaid, food stamps, everything's going to have to get cut back. Now, if it was going to be unpainful, then let's say GDP is booming. The economy is just killing it. It is doing amazing. Well, in that scenario, they might not even need to raise taxes, right? Because let's say, for example, you're selling a good at $100 and you've got 10 people who want to buy it. But let's say if I make the price $50, now I've got 500 people who want to buy that good. Even though I'm selling it for less, I'm making more money because more people want to buy it. So if the economy is doing so well and GDP is so high, well, my tax revenue might be high enough that I don't even need to increase my taxes in order to create a higher revenue. And in fact, increasing taxes might actually disincentivize people and lower my revenue. So in that scenario, maybe the government doesn't need to increase taxes. And if they're making so much money, maybe they can keep the government spending going as is. I'll let you decide how likely that is. Now, here's probably the most likely scenario of what will probably happen and what the government could do. And I'll do the analogy first with the average person, right? That same $50,000 person. So let's say this person gets their job back and they're making $80,000 a year. Well, they might be frugal at first, right? They might kind of save some money, decrease their spending a little bit just to pay off some debt, right? And kind of get in a better position and even this out. And then once they do that, then they'll start spending again and start kind of racking up that credit card. It's kind of like you pay off that credit card and then you just keep swiping that credit card again and it comes right back up. And so you never really get out of the debt, but you push it back further because you're paying it off and then you're racking it back up again. So this person, instead of maybe having to declare bankruptcy in 10 years, well, when they're at year maybe 7, they start paying that debt off and then they're able to extend it to 15 years. And then when they approach that, maybe they pay it off a little bit more and then they go back to their lifestyle and they extend it even further. So the government could theoretically do that as well. They could increase taxes for the time being. They could decrease some government spending, pay off some of this debt to prevent us from getting to the point where, right, their minimum credit card payments are too high and they can't even do anything but declare bankruptcy. They can push that back by paying off some of this debt. And then once they've paid it off and they've got a little bit more wiggle room, instead of paying all of it off, because that will take a very long time and a very painful and slow growth for Americans, they can push it back just a little bit. and then go back to the normal spending, right? Then they can decrease interest rates again, and they can decrease taxes again, and increase government spending. And then as that debt number creeps up again and gets close to where it's dangerous, and they might have to declare bankruptcy, bring it back again. Let's increase taxes again. Let's decrease government spending again. Let's raise interest rates again. And then they can just kind of keep doing that and keep pushing back the date. So where maybe that terrible crash might have been 2030, they're able to do that and push it to 2035 and then 2040. And I don't know, maybe they can do this forever, maybe they can't. I'll leave that up to you to decide. But I hope that helps. If you guys learned anything new, give this video a thumbs up. If you guys think anyone else would benefit from this information, share it with them. If you want to see more videos like this, consider subscribing to the channel. Thank you. Until next time.